Your money, your business. This is Financial Poise Radio, the spoken word sister of financialpoise.com.
Hello, everyone, and welcome to Financial Poise Radio. I'm Christopher Cahill, the host. In a few moments, the guest, Larry Swedroe, will be on. Larry Swedroe is of the BAM Alliance. He knows about stock picking, and he knows about alpha. He knows about beta. He's written books about them, many books, and he's mastered the scholarly literature about them. But he will convey the basic wisdom that he has derived from the scholarly literature in ordinary language delivered in a rich Bronx accent. I urge you to stick around and listen to my conversation with Larry Swedroe. And you can catch other conversations with Larry Swedroe from last year, looking into the archives of Financial Poise Radio, which you can find on financialpoise.com. Speaking of financialpoise.com, on there you can find everything one needs to know to start understanding crowdfunding. There is a column, Crowdfunding for Investors, right there on Financial Poise, written by David Friedman, who has published one of the leading books on crowdfunding. There's also the site within Financial Poise called Crowdfunding Investor, an entire site devoted to the topics, to the statutes, to the regulations, and to the fundamental approach and questions and issues involved with crowdfunding. So today I just wanted to mention the article by David Friedman and Matthew Nutting, July 6, 2016, in Crowdfunding Investor, entitled, "Who Should Invest in Seed Stage Companies Under Regulation A+." Now, if none of that makes any sense to you, but you're interested in crowdfunding, you're interested in getting in on the ground floor of some exciting new opportunities, you should read the article. I think one other inducement to reading the article, which got me to read it, was the fact that Nutting and Friedman interviewed Sarah Hanks. Sarah Hanks is the chief executive officer of CrowdCheck, a Virginia-based compliance and due diligence firm, and one of the most brilliant people I've ever had the pleasure to speak with in my life. She is a great friend of Financial Poise Webinars, another site on Financial Poise where professional education, and I'll call it semi-professional education for those of us who are not accountants and lawyers, is provided in a webinar format. And Ms. Hanks has been a brilliant panelist on a number of webinars I had the pleasure and fortune and privilege to moderate. One more plug for Financial Poise column. Do you need an estate plan? Well, it's an uncomfortable question, but it's asked in the form of an article, a column written by Michelle Huntke, a trust and estates attorney, entitled, "Do I Need an Estate Plan?" It's on Financial Poise, August 8th, 2016. She points out right at the head, not burying the lead, that this question is more than the question of whether or not to have a will or a codicil to a will. There are issues of incapacitation, disability. The fundamental question behind all of this is better recast as, you want that the courts or the legislature would make these decisions for you? That is the default if you don't make them yourself. Well, speaking of death, there are evidently 400-year-old sharks plying the waters outside Greenland. This is according to realclearscience.com, an article by Ross Pomeroy, dated August 11, 2016, and itself based on an article in Science Magazine from August 2016, volume 355, issue 6300, if this interests you on a scientific level. In the Real Clear Science article, I will read two little selections. First, crystalline proteins within the eye are formed around the time an animal is born and remain essentially unchanged for life. These proteins contain a fixed amount of carbon-14, a radioactive isotope of carbon that decays at a known rate. think we have these in our eyes too, which means that if you want to determine how old a dead person is, you don't have to saw off the arm and count the rings. You can just dig something out of their eyes and carbon date it. Well, that's how they arrived at, the scientists involved in the article that's published in Science, how they arrived at the age of these Greenland sharks. That's pretty old, or I should say pretty long-lived. The Greenland sharks now have the title for the longest lived vertebrate of them all. I'll quote one more sentence from the article. I mean, if these things live 400 years, it only follows that the following is true, and I quote, "Based on the results, the researchers also estimated that these animals might not reach sexual maturity until 156. 156 years. That's a long time to wait. You don't have to rely on me for that authority, of course. One can turn to Philip Larkin, a great poet who declined the offer to be Poet Laureate of England and who lived from 1922 to 1985. In his poem Annus Mirabilis, he memorably began with the following lines. Sexual intercourse began in 1963, which was rather late for me, between the end of the Chatterley Ban and the Beatles' first LP. The Chatterley Ban refers to the suppression of Lady Chatterley's Lover, a bawdy novel by the British authorities in the 1950s, a low point in modern freedom of the press in the UK. But let's leave that to the side. This theme was further explored by George and Ira Gershwin in the song It Ain't Necessarily So, which was from Porgy and Bess, a 1935 musical, which is still, and I'm glad it is, performed all over the world every year. Well, in the musical Sportin' Life, the character Sportin' Life sings It Ain't Necessarily So, which contains the following lines. Methuselah lived 900 years, Methuselah lived 900 years, but who calls that livin' when no gal will given to no man what's 900 years? Well, I admit I have a very sentimental attachment to the song because I saw it sung by the very great bass baritone William Warfield many years ago, of course, who himself recorded that song and other Porgy and Bess songs in 1963. Hey, that's the same year that Philip Larkin referred to. And Warfield recorded these songs with his then wife, the prima donna assoluta, Leontine Price, one of the finest voices of all time. I also had the rare pleasure of hearing in recital. But our number today is not 900 years, it's 400 years. It is 2016, and 400 years ago, this year, Shakespeare and Cervantes died. So they died around the time some Greenland sharks were born. So one can say that the Greenland sharks were born around the time Shakespeare and Cervantes created some of their characters, which in certain senses live as certainly as the extant elder Greenland sharks. Howard Jacobson, a great and extant British novelist and Man Booker Prize winner, has a book out this year entitled Shylock is My Name, in which he took one of those great Shakespearean characters, Shylock, and poses Shylock as a living, breathing, 400-plus-year-old man who encounters a grieving widower in a graveyard, and the novel rolls out. And if I haven't interested you enough in the novel by telling you that in the context of Greenland sharks, well, I don't know what to say. But all of this reminds me to remind you that the Mel Brooks, Carl Reiner shtick, The 2,000-Year-Old Man, which was first recorded in 1961, is still immensely funny. Now let's get on to our interview. Larry Swedroe joined the BAM Alliance 20 years ago and is its Director of Research. Larry was among the first to write a book that explained the science of investing in layman's terms, and it's entitled The Only Guide to a Winning Investment Strategy You'll Ever Need. Larry has since authored by himself 7 more books and has co-authored 6 others, with a 7th to come soon. All of these books are about investing. We were privileged here at Financial Poise Radio to have Larry as a guest twice in 2015. Larry and I discussed his co-authored book, The Incredible Shrinking Alpha, and What You Can Do to Escape Its Clutches. Andrew Berkin was the other author. Larry's upcoming book, which has the same co-authors, is Your Complete Guide to Factor-Based Investing, The Way Smart Money Invests Today. In all of his books, most of the 2 I've read, I can tell you the style is engaging and accessible while conveying the findings and meaning of important scholarly research in layman's terms. Good for us and good for his role in creating the BAM Alliance's formal investment strategy recommendations. Larry's occasional writings can be found in many places, including mutualfunds.com and ETF.com. After his appearance on this program, you may find Larry slumming on NBC, CNBC, CN, and Bloomberg Personal Finance. Larry Swedroe holds an MBA in Finance and Investment from NYU and a bachelor's degree in Finance from Baruch College in New York. Larry Swedroe, thank you for again being on this program.
My pleasure, Chris. Good to be back.
All right, well, just briefly, Director of Research. Larry, first, if you could explain your position at BAM and its relationship to current scholarly research on finance, including behavioral finance.
I'm the Director of Research, as you noted, for the Buckingham family of financial services, which actually incorporates 2 businesses. One, our own registered investment advisory firm called Buckingham Asset Management. We advise on approximately $8.5 billion with offices today in 12 cities around the country. But we also, part of the BAM Alliance, for which I act as the Director of Research, which is called an alliance of 150 or so like-minded firms. All of us are fiduciary advisors, registered investment advisors, and all the advice we give, we pledge, is not based on anyone's opinions, but is based upon peer-reviewed academic evidence from journals such as the Journal of Finance, Journal of Portfolio Management. So if we're going to live up to that standard, someone has to read all of the literature. And every quarter I read about 30 journals and probably another 50 or so papers that have not yet been published. And my job then is to write up these dense academic papers into 3 or 4 pages or so, telling people, here's what the research looked at, here's what they found, and most importantly, what implications from an investment strategy the research has for investors. So that's my role, is to be an educator and help people understand how to use the academic research.
All right. Now I'm referring to an article you recently published in ETF.com, ETF standing, one might expect, for exchange traded funds, so ETF.com. The name of the article is Swedroe, Overconfident Enemy in Mirror. And it didn't surprise me anyway, because I'm old enough to remember the Pogo comic strip, but you finish with a quote from it: "We have met the enemy and he is us." So I'll start with another quote. You are referring to 2 researchers, Daniel and Hirschleifer. And you write, Daniel and Hirschleifer conclude that, 1, there are anomalies in financial markets, unprofitable active trading, and patterns of return predictability, those are the anomalies, that are puzzling from the perspective of traditional, purely rational models. And 2, models of overconfidence and of the dynamic psychological processes that underlie overconfidence can plausibly explain why these patterns exist and persist. Overconfidence provides a natural explanation for why investors who process the same public information end up disagreeing so much. That's the précis that you created for that article. And then let me ask you, overconfidence and overprecision, something else you introduce in your article. What are these things and how do they manifest themselves among stock pickers?
There's a whole body of research from the field of psychology, human behavior, that demonstrates that it's an all too human condition, Chris, that we are overconfident of almost everything. It doesn't matter whether you ask people whether they are better than average drivers or better than average lovers. And it doesn't matter which country you ask the question, you will get an answer that ranges in the 80 to 90% range where people say they are better than average. Now, we know by definition only half the people can be better than average, so this is a problem. It's actually a good thing, I think, in most areas of our lives. I point out that imagine if we all woke up in the morning, looked in the mirror, and said to ourselves, boy, I'm dumb, ugly, stupid, and nobody likes me. The suicide rate would be very high. So the fact that we are overconfident about how well liked we are, how good looking we are, or anything along those lines is actually a healthy attribute that helps us get through life with a much better framework. However, from an investing standpoint, if we're overconfident of our skills, and there's a tremendous amount of research demonstrating that this is the case, and not just for individuals, but professional investors as well, that we are overconfident about our abilities to pick stocks and time the market. And if that's the case, then we are likely to make some very serious errors. So here's a couple of them. One is we are likely to fail to diversify, despite the fact that diversification is the first and most important principle of prudent investing. It's been called the only free lunch in investing because you can reduce risk without reducing the expected return. And yet, if you're overconfident of your ability to identify which stocks will do well, why do you need to diversify? You know the stocks that you will choose are going to outperform, or at least have a high degree of confidence that they will. You're likely to try to jump in and out and time the market because you believe you can do so, despite an overwhelming body of evidence that there are no such people who have that skill set. And you also probably are overconfident about your ability to identify the very few active managers and the mutual funds they run, which will outperform in the future. There's always a few that do. Unfortunately, there's no evidence that anyone has found a way to do that. So you're likely to make these big errors, including overestimating how much risk your stomach can handle. And then when the risk shows up in periods like 2008, you will likely panic and sell.
Well, I guess everyone in my office knows that I do hit the best line drives on my softball team, well above average. But I also have to admit that even though all that's true, I got gold all wrong in the months before Volcker and Reagan strengthened the dollar back in the early 80s and weakened gold. So, yes, overconfidence might help somebody at the plate, but they wouldn't help, you were saying, wouldn't help somebody who's dealing with complex milieu like investing.
And there's a related problem, which is called self-attribution bias, and that refers to the fact that we tend to take credit and attribute our successes to our skills while blaming the failure on bad luck. I know I used to be an economist for Citicorp, sold economic and market and foreign exchange forecasts, and when I got it right, I always took credit for my brilliant insights, of course. But when I got it wrong, I always attributed it to some unforecastable event, some surprise that nobody could have predicted. Well, of course, if you do that, you're a genius. You're never wrong. You just get unlucky. But if you're rational about it, you recognize that you probably were lucky and unlucky and not smart and then stupid. So that's another problem that we have, that overconfidence creates this self-attribution bias and allows the overconfidence to persist.
Well, I guess I would call it the Don Quixote bias.
Yeah.
Betraying my humanistic education, I guess. Because all his successes he attributed to the nobility of his love, and all of his failures were due to Freston, the malignant enchanter who dogged his every step.
There's also evidence that we have a problem called over-precision. So that I might ask you, Chris, an example. What do you think the market will end the year up? And you'll say, 8 to 10%. And I'll say, how confident are you of that range? And you might say, 90%. Well, the evidence shows that when people are 90% confident of something happening, they get it right about 50 or 60% of the time. So we are overconfident or about our precision in being able to estimate the accuracy of our own beliefs. And that too creates too much overconfidence, taking too much risk, failing to diversify, etc.
All right, well, let's just talk then about the dimension of activity. So these stock pickers, if a stock picker invests more actively, is it the case that they tend to lose more? And related to that, perhaps, why is it that stock pickers tend to buy, the stocks individual investors tend to buy underperform, and those they sell overperform?
Right. I'm sure that's never happened to any of your listeners. Here's what the research shows, and then we can explain why this is the case. And I've always find it interesting that virtually no investor I talk to has ever thought about the decisions they make when they're buying or selling in the way that I'm going to explain it, which is the only right way to think about it. But the evidence does show that, number one, the stocks individuals buy, and this is true for both men and women, do tend to go on to underperform on average after they buy, and they tend to go on to outperform after they sell them. Now, we know this must be a zero-sum game, so somebody has to be on the other side of the trade. If you and I are trading and on average we lose, whoever's on the other side of that trade is likely a winner. It turns out it's the professional investors who are the winners. So here's the problem. When you and I trade, institutions today are occupying about 90% of the trading activity, or they're responsible for it. So that means there's a 90% chance when I buy a stock that the seller is an institution. Now, I think if we are honest with ourselves, look in the mirror and ask the question, this is a zero-sum game. If I buy Apple, it will either outperform the market or underperform the market from there on. Only one of the two people can be right here. I bought it, so I'm betting it will outperform. The institution who sold it to me is betting it will underperform, otherwise they would continue to hold it. And only one of us could be right even before we account for expenses. And of course, if we're honest with ourselves, it's, we would have to admit it's much more likely that the Warren Buffetts, the Goldman Sachses, the big institutional traders, hedge funds, etc., people who are doing it all the time, full time, who are PhDs in finance, and now today world-class scientists, physicists, mathematicians, that's who your competition is. So the odds of your being right have to be low, and that's what the research shows. So every time you trade, you're making a bad bet where the odds are against you. So clearly, the more often you trade, the worse your results are. So why do people trade a lot? The only logical conclusion is they're overconfident of their skills, and the research shows that the more people trade, actually the worse their results are. And that's because they're spending this money. Now, here's the interesting thing. Because 90% of the time, Chris, it's one institution is one side of that transaction. If an institution is buying, they've got a 90% chance that it's another institution on the other side. And you might ask, while in the first case, we knew who the sucker at the poker table was likely to be, when Goldman Sachs is trading against Morgan Stanley, pretty hard to identify who the sucker is. So they probably end up with about a zero experience before their expenses, but they're both spending money in the effort of trying to exploit each other. So here's what the research shows. On average, the stocks institutions buy do go on to outperform by about 70 basis points a year. However, the total cost of exploiting and capturing that 70 basis points, which they're, quote, stealing, if you will, from individual investors, has exceeded on average about 2%. So the investors in the mutual funds who are run by the Goldmans, et cetera, are actually losing more than about 1% a year on average because of all of the costs.
We've met the enemy, and the enemy is the institutions. Well, I guess it's tedious to refer to Seinfeld, but I'll do it anyway, because there's a famous episode, George Costanza, who's nobody's idea of a genius and nobody's idea of somebody who avoids overconfidence, decides to do the opposite of everything he wants to do and flourishes. So maybe one could do worse than telling somebody who has the impulse to trade a lot to do the opposite.
I actually use that series of Seinfeld quotes in my speech that I do about how to be a better investor, and that's one of them. And along the lines of that, if I could quote Warren Buffett here, Warren Buffett has said things like, inactivity strikes us as intelligent behavior. He's also told investors he makes more money when snoring than when active. So the best advice for most individuals, if they're tempted to act because of some piece of news, information, or nerves about the market, or some guru made a forecast, they're almost certainly better not acting than acting. So you're absolutely right. We know individuals get tempted to act, and in those cases, they are clearly better off doing the opposite of what their instincts are telling them.
Yes, if the girl doesn't answer the phone the first time you call, what's the chance you're going to do something good by dialing her number again? I'll quote Warren Buffett again. I'm quoting you, quoting Warren Buffett in your writing. The most important quality for an investor is temperament, not intellect. Success in investing doesn't correlate with IQ. Once you have ordinary intelligence, what you need is a temperament to control the urges that get other people in trouble. And that leads me to my next question. If overconfidence, which helps explain exceedingly active investing by stock picking individuals, has a systematic way of injuring one's portfolio performance, should we be surprised that men trade more actively than women?
So I happen to agree that men are more confident than women. I have, I'm not a trained psychologist. I have a view. I call it the testosterone factor. So men are more confident of the skills they don't have. Women know better. And because men are more confident of skills they don't have, they do trade more, and therefore that leads to worse returns. It turns out that the stocks women pick do just as poorly as the stocks men pick, but they get higher returns because they're transferring less profits to the stockbrokers and the market makers in lower transactions costs. So they have the same lousy gross returns, but their net returns aren't quite as bad as those of the men.
Well, being that there's a disparate impact on men, I think the feds ought to get in there and rectify the situation. There are two important concepts, however, that must be understood. I think you do a great job of laying these out in your shorter writings and thoroughly explaining them in your longer writings. And they are beta and alpha. These are means by which to conceptualize what a true gain is from an investment standpoint. And if you wouldn't mind spending a few minutes talking about that.
Well, let's see if we can clarify these terms, which can appear to be opaque to many people. So alpha is the return above an appropriate risk-adjusted benchmark. So in simple terms, Chris, if you buy junk bonds and you compare yourself to a treasury bond index and you happen to outperform because the economy did well and companies tend not to go bankrupt in that kind of environment, then while some hedge fund who was engaging in that behavior would claim alpha, a financial economist would say, no, that's not true. Now, if you beat an index of junk bonds, and there are such indices, then you could claim alpha because you outperformed an appropriate risk-adjusted benchmark. So similarly, you could think of it if you buy emerging market stocks, countries like Brazil and Russia, Indonesia. Those are clearly more risky than those of developed countries like the U.S. You can't claim alpha if you outperform the S&P, but if you outperform an index of emerging market stocks, and Vanguard has an emerging market index fund, then you could rightly claim alpha. So alpha, you have to make sure if someone's claiming it that they're presenting their returns against an appropriate benchmark. So you don't compare small cap stocks, which are riskier, to an S&P 500 and claim outperformance. You don't buy distressed value companies that have low prices because no one wants to buy them because they appear risky, and then claim outperformance against some growth index like the S&P 500. So that's the definition of alpha.
Now, what about, yes, and then beta, which is key to understanding your analysis of factors in your upcoming book.
Right, so here we can get a little confusing because beta is used in two ways. One, in general terms, it's used to think about any factor, or think about it, that's the term academics use, factors that explain stock returns. You might think of them much more simply as a characteristic or a trait. So a factor could be a low PE ratio, low price to earnings ratio. A factor could be the market capitalization. So stocks that are under $1 billion act differently than stocks that have market capitalizations of $50 billion or more. That's called the size factor. There are several other factors, and beta just means how much exposure you have to that factor. So there's also the term, and here's where the confusion comes in, beta is also used to determine how much exposure you have to the market factor or the equity risk premium. So someone who buys high-flying tech stocks might have a beta of his portfolio of 1.5, which means his portfolio is basically 50% riskier than the market, which has a beta of 1. So if the market goes up 10% and you have these high beta stocks, your benchmark is really 15%, or 10% times 1.5. If you only earn 13, you didn't outperform your appropriate benchmark. On the other hand, let's say, Chris, you own a lot of defensive stocks like grocery stores or Walgreens, those type of companies whose performance doesn't co-vary with the stock market so much, or the economy tends to be more stable, hence the term defensive. Well, that might have a portfolio beta of only 0.7. Well, if you earned 8% when the market got 10, your benchmark is really that 7, or 10% times 0.7, and you generated true alpha, even though you have a lower return than the market, but your benchmark is different. So beta is often thought of as how much exposure you have to the market risk, but it can also be how much exposure you have to any factor, such as the size factor, the value factor, and other factors like momentum and profitability, which I described in the new book.
Okay, so then if you make a general statement about how hedge funds have this alpha or that alpha, if the analysis takes into account the different kinds of strategies hedge funds have and calculates a different alpha for each because each has a different beta, one being more defensive than another, one being more tech stocky than another, then you are able to make a general statement about how hedge funds have done. And this you do, actually, looking at some research in the field in an article you wrote for ETF.com called Hedge Funds Grow, Returns Fall. And this is interesting because, as we're trying to figure out what to do as investors, knowing that the enemy is us when we're individual stock pickers, well, maybe we'd be better off leaving it to the pros and getting access somehow to a hedge fund, for example. They seem to be making a lot of money. And here's the quote. From 1998 through 2002, hedge funds produced an incredible alpha of 9%. So that's 9% better than the appropriate beta. However, from 2003 through 2007, their alphas went to 0.7%. And from 2008 through 2012, the alpha became minus 0.45%. So what the devil happened to hedge funds?
Well, first, Chris, I think I don't have the data in front of me, but I think you misread the numbers. The second of the 5-year periods there from 2003 through 7, I think the alpha was actually negative 0.7%, not positive.
You're correct, Larry. You're correct. You're correct.
And the last of the 5-year periods there from 08 through 12, the alpha was actually minus 4.5%, not 4.5%. So the alpha has gotten much worse.
Yeah.
So in my book, The Incredible Shrinking Alpha, I point out 4 big themes to explain why this is the case. So the first is that the academic research has uncovered strategies that hedge funds used to use and converted what was once alpha into beta. So let me give you a simple example of what we mean by that. So academics can uncover these factors that have higher than market returns, I would say, in one of 2 general ways. They have a theory, and they start out with a theory such as, well, small stocks are riskier than large stocks. Investors ought to get compensated for the risk, the incremental risk they take in buying small stocks. Therefore, my theory is that small stocks over the long term will produce higher expected returns as compensation for their greater volatility and greater risk. So that's your theory, and then you look at the data, and lo and behold, yes, small cap stocks have provided an annual average return of about 3% above the market. That's one way to do it. Another good example would be another way to do it is to study the performance of the investors who have been persistently able to beat the market and see if you could use this term reverse engineering and figure out, was it skill in picking individual stocks that explain their outperformance, or can we identify some common trait that anyone can invest in if you know what the trait is, for example, like small stocks? But it might be something else. You might hypothesize, for example, Warren Buffett makes no secret about the fact that he likes to buy cheap stocks. Academics call them value companies, stocks that have low prices to earnings, for example, or cash flow or book value. So academics can say, all right, let me check and see. Let's run the data, look at the kind of stocks they buy to see if I can identify some common traits. And if I'm able to, I can create an index of those stocks, and I can replicate the performance of the great managers. And that's where a lot of the academic research has actually come from, is replicating the performance of investors who are able to deliver alpha. But once I know, for example, that value stocks outperform, and Vanguard creates an index fund that allows me to invest as little as just 8 basis points in exactly the same types of stocks that Graham and Dodd, for example, and many other legendary value investors were buying, that converts alpha into beta, or just loading on some common trait. And the fact is, the academics uncovered that value factor in the 1980s, and that eliminated one source of alpha, because now anyone can replicate it. It wasn't long after a group of academics doing work, who knows if they came up with a theory or they were just trying to reverse engineer people like Buffett's returns. They also discovered, and perhaps it shouldn't have been a secret, because Buffett also said he'd like to buy quality companies, and they found that companies who are more profitable, despite the fact that they traded higher valuations, meaning higher P/E ratios, they outperform even after accounting for that. And companies, he's also said he likes to buy quality companies. And academics went back and researched this quality factor and came up with some common traits. So if you buy companies that have low levels of financial leverage, little debt, you don't buy companies that have high operating leverage like an airline does, where if you fall below a certain capacity, your profits collapse. You tend to avoid companies that are highly cyclical, have more stable earnings, have high what's called asset turnover, so they turn their inventory frequently. Well, if you buy stocks like that, they have shown, there's a paper called Buffett's Alpha, another one called Betting Against Beta, that you actually could create an index of stocks, invest just like Warren Buffett without his capacity, of course, and his ability to use the leverage provided by his insurance company. But in terms of stock picking, you would literally have been able to virtually replicate Buffett's returns, and Buffett's alpha becomes statistically indifferent from zero. There's almost no advantage there.
Right. So it's not the brilliance of hedge funds that results in the returns. It's a manner of analyzing the market that lots of people are doing. So you're just doing, as a hedge fund, what other people do. So what value are you bringing for the rather significant fees hedge funds bring? In other words, what is your alpha?
Right. So let me see if I can clarify that a little bit, because hedge funds, as you noted, in the first 5 years of that 15-year period, and also before that period, but 98 through 02, they were generating almost double-digit alphas. So they, in effect, had uncovered these factors way before the academics. And if you happen to invest with them or other value investors, as one example, or small stocks or profitable stocks, that was truly alpha. And you could charge a lot of money for those and deserve those fees because that was truly a skill set. But now, once Vanguard and other fund families created mutual funds that could replicate that and charge very low fees, then alpha became beta. I could just buy the Vanguard funds and other fund families, what has now become this term smart beta, and invest and get these same characteristics. So why should hedge funds be able to charge 2 and 20 when a Vanguard is charging 10 to 20 basis points, or other ETFs maybe charging 20, 30, 40 basis points? So that's one of the big problems there. But there are other factors, Chris, we can also discuss.
Yeah, let's just go through them quickly and then wrap this up. One of them being one of my favorite factors, not factor as an investment analysis, but rather explanatory aspect of lower hedge funds, which is the paradox of skill.
Right.
When everybody is muscular and good and highly trained and taking steroids, it's very hard for a baseball player to break through the pack and consistently perform at an extraordinarily high level. Well, similarly, when you have the best talent in the country being drawn into hedge funds and private equity and so on, well, they're competing with each other. It's hard for any one of them to do so much better than the others. Is that about it?
You hit it on the nail, and just help the audience understand this issue. In 1945, coming out of World War II, when Warren Buffett traded, the odds were exactly the reverse of what they are today. In other words, 90% of the stocks were held directly by retail investors in their brokerage accounts. So there was a 90% chance when he was trading, the person on the other side was nowhere near as skilled as he was, and therefore he could exploit that. If hedge funds were around, other institutional investors, there was a big sheep herd that could be sheared and exploited. The problem is today it's the other way around. The amount of retail investors, that supply of sheep, continues to collapse because investors are waking up to the fact that the competition's just too tough and they keep losing at it, so they eventually drop out of the game. And that's true even of mutual funds. About 7% of them disappear every year. It's not the ones who are winning that are going to disappear, and it's not the ones who are winning as individual investors. So clearly the losers are the ones with less skill. So that means the remaining competition's getting tougher and tougher every year. Eventually, if you think about it, you'll end up with Warren Buffett trading against Peter Lynch. Who exactly is the sucker at that poker table?
Well, we do have the Buffett bet with hedge funds, and I invite people to read about it. Investopedia has a very good article, The Buffett bet with hedge funds, speaking of highly talented people going against one another. It's not all been one way, although Buffett has the better of it, and it looks like he probably will prevail in the bet.
Well, the hedge fund returns have been so god-awful that for the last 10 calendar years, the hedge fund industry has returned less than 1% a year, which has underperformed every single major equity asset class in the world, every major safe bond index, including even virtually riskless one-year treasury bills. So on average, doesn't mean all hedge funds have underperformed on cost. Investors are leaving tens of billions of dollars of their hard-earned money on the table and transferring it to the wallets of the country club set who are just exploiting their ignorance.
Well, on that highly uplifting note, I want to thank you, Larry. I'm looking forward to your next installment on this show, but I want to thank you for being with us today.
My pleasure, Chris.
Financial Poise Radio, my guest has been Larry Swedroe, Director of Research for the BAM Alliance. I am Christopher Cahill. Financial Poise Radio is produced by Stephanie Strait. We thank you for listening, and let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.financialpoise.com. Each week, Financial Poise Radio brings you news and education about finance, investing, business, and law. To see a short written summary of this episode, go to www.financialpoise.com. Financial Poise Radio is a production of Financial Poise Radio Productions, LLC.